Welcome to the Wealthfinity channel and our definitive guide on mutual fund expense ratios. In this guide, we will dive deep into what mutual fund expense ratios are, how they are calculated, and why they are important for investors to understand. We will also provide examples and tips on how to compare expense ratios across different mutual funds to make informed investment decisions. Whether you're a seasoned investor or new to the world of mutual funds, this guide is a must-read for anyone looking to maximize their returns and minimize their costs. So, let's get started and unlock the full potential of your investments with our Wealthfinity guide on mutual fund expense ratios. Mutual funds are a popular investment option for many individuals and can offer a variety of benefits, such as diversification and professional management. However, it's important to understand the costs associated with mutual funds, including expense ratios. Expense ratios are the annual fees that mutual funds charge to cover their operating expenses. These fees are expressed as a percentage of the fund's total assets and can include costs such as management fees, administrative expenses, and 12b-1 fees, marketing and distribution expenses. When evaluating mutual funds, investors should pay attention to the expense ratio as it can have a significant impact on the fund's returns over time. A higher expense ratio means that a larger portion of the fund's assets are being used to cover expenses, leaving less for potential returns. On the other hand, a lower expense ratio means that more of the fund's assets can be used to generate returns for investors. To use expense ratios when evaluating mutual funds, investors should compare the ratio of the fund they are considering to the average ratio of funds in the same category. For example, if an investor is considering a stock mutual fund with an expense ratio of 1%, they should compare it to the average expense ratio of other stock mutual funds, which is typically around 1.5%. A fund with a ratio that is significantly lower than the average for its category is likely a better value for the investor. A mutual fund's expense ratio is the annual fee that the fund charges to cover its operating costs. This fee is expressed as a percentage of the fund's total assets and is deducted from the fund's returns on an ongoing basis. For example, if a fund has an expense ratio of 0.5%, it means that 0.5% of the fund's assets are used to cover operating expenses each year. There are several types of costs that are included in a mutual fund's expense ratio. The largest component is typically the management fee, which is paid to the fund's investment manager for their expertise and time spent managing the fund's portfolio. Other costs may include administrative expenses, such as accounting and legal fees, as well as marketing and distribution costs. It's important to note that the expense ratio is not the only factor to consider when choosing a mutual fund. Other factors such as the fund's performance, risk level, and investment objective should also be taken into account. However, the expense ratio is an important piece of information that can help investors compare the relative costs of different funds and make more informed investment decisions. A mutual fund's expense ratio is the annual fee that the fund charges to cover its operating expenses. This fee is expressed as a percentage of the fund's assets. For example, if a mutual fund has an expense ratio of 0.5%, that means that for every $100 you invest in the fund, 50 cents will be used to cover the fund's expenses. Expense ratios can vary widely among mutual funds. Some funds may have expense ratios as low as 0.05%, while others may have expense ratios as high as 2%. It's important to note that expense ratios can have a significant impact on your investment returns over time. For example, if you invest $10,000 in a fund with an expense ratio of 0.5% and the fund earns an average annual return of 8%, you would earn $8,040 in profits after 10 years. However, if you invest in a fund with an expense ratio of 1%, you would earn only $7,764 in profits over the same time period. For example, let's say you invest $10,000 in a mutual fund with an expense ratio of 1%. After 1 year, the fund has returned 8%. Your investment would be worth $10,800, $10,000 plus $800 in returns. However, if the expense ratio was 0.5%, your investment would be worth $10,840, $10,000 plus $840 in returns. This may not seem like a big difference, but over time, the impact of expense ratios can add up. It's also important to note that some mutual funds may have additional costs, such as sales charges or redemption fees, which can further reduce your returns. Be sure to carefully review the fees associated with any mutual fund before investing. So, what can you do to minimize the impact of expense ratios on your investing returns? One strategy is to look for low-cost index funds or exchange-traded funds, ETFs, which tend to have lower expense ratios than actively managed mutual funds. Another strategy is to compare expense ratios across different funds and choose the one with the lowest ratio. The main things to keep in mind when considering the expense ratio are: lower expense ratios are generally better than higher expense ratios. The expense ratio is important, but it is not the only factor to consider when choosing a mutual fund. The expense ratio is deducted from the fund's return, so a lower expense ratio will mean higher return for you. When choosing a mutual fund, it's important to consider the expense ratio in relation to the fund's performance and risk profile. A fund with a high expense ratio may be worth it if it has a strong track record of delivering high returns. However, if a fund has a high expense ratio and a poor performance history, it may not be the best choice for your investment portfolio. Mutual fund expense ratios are an important consideration when selecting a fund to invest in. It's a metric that reflects the annual costs associated with operating a fund and can have a significant impact on the fund's overall performance. By understanding what the expense ratio is, how it's calculated and how it can vary among different funds, investors can make more informed investment decisions and increase their chances of success. In conclusion, mutual fund expense ratios are a crucial factor to consider when choosing a mutual fund to invest in. They represent the annual fees and expenses associated with a fund, and can have a significant impact on the overall performance and returns of your investment. By understanding how to calculate and compare expense ratios, you can make more informed decisions and choose mutual funds that align with your investment goals and risk tolerance. Remember to always do your own research and consult with a financial advisor before making any investment decisions.